Let's talk about Microsoft's RSUs. What are they? How do they work? And what should you do with them? My name is Scott Caulfield. I'm a CPA and CFA charter holder, and I am the founder of Sophos Wealth Management. So Microsoft RSUs are just a form of equity compensation. There's kind of two kinds of awards. Typically, there's your on-hire awards as well as the annual stock awards. Both vest just based on your time of service. How long have you worked there? So on-hire awards at Microsoft typically vest over 4 years. You receive 25% each year on the anniversary date of your hire. The annual stock awards are given in August, and they have a 5-year vesting schedule. So 20% per year, and that occurs quarterly each February, May, August, and November, beginning the first quarter after they are awarded. So let's just kind of look at a little example, at least for the on-hire awards. Let's pretend an employee received 800 shares, 800 RSUs when they're hired. So on their first anniversary, 1 quarter or 200 shares will vest. Let's pretend Microsoft's price is a little lower than today. Let's pretend it's $300 a share. That would give the employee ordinary income on that vesting date of $60,000. The federal default level, which Microsoft follows for tax withholding, is 22%. This means Microsoft's going to put aside 22% of your shares to pay for taxes. So that's going to be 44 shares. That leaves you with 156 shares. Now, there's no additional tax impact if you go ahead and sell your shares on the vesting date, or very, very minimal, because the share price that date will essentially be equal to what the grant price is. So the way that I like to frame this is you should think that Microsoft just handed you an envelope full of cash. What do you want to do with it? Investing is a great option, but often investing in your own employer is probably not your first choice of what you should do with that money. You can take advantage of Microsoft's 401k plan, ESPP. You can fund other investments. You can fund college savings. The world is really your oyster. It is kind of worth noting, too, that 22% default tax rate is often too low for very high earners. So if you don't take that into account, you might have an additional tax bill when you file your taxes at the end of the year. The only other thing I think to keep in mind is what happens if you do hold on to your shares. So if you hold the shares and the price appreciates, you will have a capital gain in the future. If you've held those longer than 1 year after the vesting date, that's going to be long-term, which is advantageous. And if you hold it less than 1 year, it'll be short-term. The nice thing about RSUs is they do give you a lot of planning opportunities, and that's something I'm always happy to discuss. So if you have any questions or would like to discuss your situation, feel free to reach out. Thanks a lot.